Hey everyone, welcome back to Corporate Decoder, the place where we decipher corporate filings so you don't have to. Today, we're diving into Avantor's latest quarterly report, but be warned, it might leave you feeling like you need a lab coat and a PhD just to understand it. And this report highlights a slight dip in sales, some cost-cutting measures, and a few financial maneuvers. Let's unpack it all and see what's really going on under the microscope. First, the basics. This is Avantor's 10Q. Their quarterly report for the period ending March 31, 2025. It's a snapshot of how the company performed in the first 3 months of the year. Avantor is a big player in supplying products and services for the biopharmaceutical, healthcare, education, and advanced technology industries. Think of them as the Amazon for labs and research facilities. They sell everything from chemicals and lab equipment to specialized services. Before we get into the numbers, let's note that as of late April, Avantor had over 681 million shares of common stock outstanding. This is important because it affects earnings per share, which we'll discuss later. Now, let's look at the money. These are balance sheets, a snapshot of what the company owns and owes. One important number is accounts receivable, which is the money owed to Avantor by its customers. It's sitting at almost $1.1 billion compared to roughly $1.03 billion at the end of the previous year. This is showing a healthy sign because it means sales are up. Cash and cash equivalents, which is the amount of liquid assets the company has, is at $315.09 million, up from $2061.9 million at the end of last year. More cash gives the company more flexibility to invest and grow. Goodwill stands at about $5.6 billion. This is an intangible asset that arises when a company acquires another company and pays more than the fair value of its tangible assets. It is important to watch that number as it can disappear quickly if the acquisition isn't performing well. On the liability side, the total long-term debt is about $3.3 billion. Debt is a double-edged sword. It can fuel growth, but too much can sink a company. Moving on to the statements of operations, which show how well Avantor made money during the first 3 months. Net sales, which is the top line revenue, is about $1.58 billion. Last year it was $1.68 billion, so sales have decreased year over year. Gross profit, which is the revenue after subtracting the cost of goods sold, is $534.9 million, a drop from $570.5 million in the prior year. Earnings per share, or EPS, is a key measure of profitability. Both basic and diluted EPS are $0.09, so the profitability remained exactly the same despite the business changes. This highlights some cost effectiveness. Now let's break down the numbers by segment. Avantor operates in two main segments, Laboratory Solutions and Bioscience Production. Laboratory Solutions is the bigger segment with net sales of $1.06 billion in the same period last year. Bioscience Production is at $516.4 million, a slight decrease from $522.07 experienced declines, but Laboratory Solutions took the bigger hit. Next up, the statement of cash flows. It shows how much cash the company is generating and how it's being used. Net cash provided by operating activities is $109.3 million. That means they made money from selling products and services. Capital expenditures, which are investments in property, plant, and equipment, total $28 million. Companies need to spend money to make money. Net cash used in financing activities is about $33.6 million. This includes debt repayments and other financing activities. The footnotes are where the company discloses additional details about their accounting policies and any significant events that affect their financial statements. One thing to note is the new accounting standard relating to income taxes disclosures, which goes into effect next year. This might lead to additional disclosures in the future. Stock-based compensation, which is paying employees with stocks instead of cash, is at $12.4 million. It is important to keep track of these since they don't involve cash, but they do impact shareholder ownership. There are no major legal battles looming over Avantor that they are worried about at the moment. Let's talk debt, because it's a big part of Avantor's financial picture. The report lists various debt instruments, including secured and unsecured notes with interest rates ranging from 2.625% to 4.625% to 4.625% to 4.625%. The good news is that they are paying down some loans. Avantor uses various financial instruments like derivatives to manage risks related to foreign currency exchange rates and interest rates. The goal is to reduce volatility and protect their bottom line. Finally, the report mentions a new risk factor, changes to trade policy. Increased tariffs and trade restrictions could hurt their business by increasing costs and disrupting supply chains. Now, putting all this together, Avantor is facing some headwinds. Sales are down, and they are having to rely on cost-cutting to keep things afloat. The company says the sales decline was primarily driven by reduced customer demand in the laboratory solutions segment and the divestiture of their clinical services business. But the market is competitive and economic conditions remain uncertain. They need to turn those numbers around quickly or the market will react very badly. One thing that is good is that the company has access to 1.1 billion in unused credit lines. That means it can easily cover its $702 million debt due in the next 12 months. So liquidity doesn't seem to be a problem. Thanks for watching. If you found this analysis helpful, please like, subscribe, and leave a comment below. What company should we decode next? Let us know.